What's going on out there? It's August 9th. I'm Frank Curzio. It's the Wall Street Unplugged podcast where I break down the headlines and tell you what's really moving these markets. So we're just finishing up earnings season, and holy cow. One of the most confusing times. You're probably better off just shutting off TV completely, all channels, but special financial media, which maybe I shouldn't be saying since I was on Charles Payne's Making Money yesterday. I miss Charles. I'm going to be on that show more often. But the craziness you're seeing in the markets right now is, it's not usual. You just got a bunch of people who are bearish. When the markets are terrible, everybody's bearish, or everyone's bullish, like they were the past few years. No matter what happens, buy the dip. But now, you can't figure it out. It's confusing people. And you could say, well, let me look at the economy. Is it good? Is it bad? Are we in a recession? Economists are arguing, right? The definition, we all know what the definition is. Just watch TV, right? 2 straight quarters of negative GDP growth, which we saw, but that's not really a definition. We're not in a recession. No. That's the definition of it, but unemployment is doing so much better. People are doing okay. Wages are going up a little bit. Doesn't mean we're in a recession, but are we or aren't we? No one could even know. No one can answer that question. Some people feel like they are. Some people, you look at companies when they're reporting, some people say yes, some people say no. We see things getting better. You're in a recession, you see everybody cutting back, everything terrible. Not everything is horribly terrible, but there are things that are terrible, of course, which we're seeing. But you look at the market saying, which direction are they going to go? And I'm talking about right now today, not 8 weeks ago. And we were pounding the table just because sentiment indicators are at all-time lows. All-time lows. We're talking dating back to 1993. That's when the VIX was created. Look at indicators across the board saying it's not been this bearish ever. And we're not talking about during COVID. This is worse than COVID, worse than the 2000 crash, worse than September 11th, which is crazy. And we saw stocks bounce tremendously after going down 11 out of 12 weeks. We were clearly oversold. None of that, the Fed got back on track where they had no clue that we're going to see the biggest recessionary environment since the 80s. They would say transitory trends for 2 years, right? We all know the story. Then all of a sudden they're like, oh no, we're on the wrong side. And it's, 5%, 6%, 7%, 8%, 9% year over year. Are you kidding me? Now, the Fed's on the right side of the trade here. Raising interest rates aggressively. See inflation in front of them. If it gets worse, they'll raise further. But I'm not talking about 8 weeks ago, where everything is up. Some stocks are up 20%. Some are up over 40% from their lows. We're still down. The Nasdaq's still down 20% from its highs. We just overshot. But today, right now, think about what's going on right now. It's difficult to gauge the market direction. Bulls and bears are completely split. You look at CPI, still very, very high. Still got inflation while moderating. Again, it's still high, very high. Mentioned earlier, unemployment strong, which indicates how can we be in a recession if unemployment is strong, right? If the employment rate, if people are getting hired, it would do. Really, that number was incredible. Couldn't even really pick, right? Yes, it's a lagging indicator. We see more companies lay off and freeze hiring and things like that, but that number was definitely positive. How could that number be so great in a recession? You have certain Fed presidents come out like Bullard, Loretta Mester, Barkin, Mary Daly. They say inflation out of control. It's going higher. I think the Fed funds rate should go to 4%, which is absolutely nuts. If we go to 4%, expect another 20%, at least a 20% correction from where we are right now. Giving up all those gains. If we go to 4%, it's insane. A 75 basis point hike, guys, is extremely weird. 1994 was the last time we did that. We did it 2 times in a row, and then we're going 50 basis point hike in September, at least. It's going to bring us to 3%. We were at 0 not long ago, 3%, and you're seeing the effects of that. You're seeing inflation moderate. You're seeing that work through the system. It's hurting. It's going to continue to weaken market conditions when it comes to borrowing and rates going higher. You don't have the Fed there pumping money. Quantitative tightening, right? The Fed shrinking its balance sheet, no longer buying bonds, supporting that low interest rate environment. But you have these Fed governors going, hey, watch out, inflation's still out of control. We got to raise aggressively. Yet, what do we see? Energy, gasoline prices, corn, wheat, lumber, copper down sharply from their highs, 30 to 50% across the board. And look at housing clearly cooling off, which makes sense. And imagine you're looking for a house over the past 9 months, and interest rates went from 3%, and yes, they fell under 5%, it was high 6%, but still, you're looking at what is it, $600-$700 payment increase in a month, simply by just interest rates going higher? I mean, just sitting there, but holy shit, and that comes right out of your pocket, earning right out of it. So you can see people saying, I gotta wait. I mean, I watch interest rates go all the way through 6%, now they're below 5%. I'm just going to sit on the sidelines and wait. You're seeing that in the housing market, both from buyers and sellers. I'm just going to wait to see what happens. Which means what the Fed is doing is clearly working. But a lot of those Fed governors are like, 4%, we need to go higher and higher and higher. And then you look at the 10-year, which is holding steady below 3%. It's at 2.8, which signals the Fed could be done raising rates soon after September. Let's see what the data says. As of right now, I made the case. You need to stop. You stop right away. It's just obviously working. You're seeing moderation. You're going to continue to see that going forward. If you overshoot, holy cow. Now you're talking about bankruptcies, banking problems. Even though banks are really flush with cash because they're not allowed to lend out a lot of that money, which is why they're, again, does that indicate a recessionary environment? Have you ever seen a recessionary environment when the banks are seeing, buying back their stock, right? Because their balance sheets are so strong. Right? They're buying back stock, and what else they do? They're raising the dividends. You don't see banks raising dividends during recessions. It never, ever happens. Again, the confusion, back and forth. Which is it? The average person at home, you're looking at going, I don't know. You're better off shutting the TV off. Because when it gets to earnings, it gets even better. Just finished Q2 earnings, basically. 90% of the companies reported so far. We got a few more on deck. Well, it's nuts. It's 75% of these companies reported positive earnings surprises. And you look at that and say, wait a minute. I thought we were in a recession. I thought things were 75%. That's higher than the norm of like 72%. There's the largest percent of companies reporting positive earnings surprises since Q3 2019 before COVID. How could that be? How could that be in this environment? Seems odd at first. Considering that Q2 earnings grew 7% year over year. And that's above the norm. Yes, we've seen 10, 15%, even 20% earnings growth after COVID. Pre-COVID, that was an amazing number if you're growing earnings 7%. In 2017, 18, 19, those are great numbers. 7%, holy cow. Again, looks great on the surface. When you take a look under the hood, earnings were not so great. You have the S&P 500, you take it as a whole. Just like you take the CPI, take it as a whole, and you go X food, X energy, because they're volatile, X this, X that. Love to do that. Let's remove this, and this to make everything seem all rosy and better, even though last I heard we do pay for food and energy, right? I think we do. But we're going to remove that from the CPI, just so we get a better reading. Doesn't matter if that goes up like 5,000%. You're good. There's no inflation, right? That's what we're used to, which is funny, which is great. But let's take a look at the S&P 500 earnings. Because that 7% increase includes energy stocks. And energy stocks, I'm going to give you a second to guess this, maybe 2 or 3 seconds. How much do you think the earnings for energy stocks grew year over year from this quarter to last quarter? And yes, oil went through the roof. And if someone would have told me to guess, I would have said 50%, 60%. It's 299%. That's the number. FactSet, that's how much earnings have grown within the S&P 500. Those earnings for energy stocks within the S&P 500, 299% year over year. Holy shit, are you kidding me? So if we take out energy, which we've seen, a lot of these energy stocks have come down sharply over the past 2 months, 3 months. Earnings are down for the S&P 500. They're down 4% year over year. So what does that mean? How come it's like, well, it means that analysts first did a great job significantly lower estimates into the quarter. I mean, if a company's projected to earn $1.25 for the quarter, and analysts lower those estimates to $1, which you don't see as an individual investor. Most people, they don't report when they're lowering earnings a little bit. They report upgrades, downgrades, and they'll show that number on the bottom of the screen. They beat earnings by this much. That earnings is the consensus earnings. That consensus earnings has gone down considerably into the quarter. So the analysts will lower that number from, say, $1.25 to $1 for a company, right? And you report $1.05 in earnings, and what does it say? This company beat estimates. They beat them by 5 cents. That's all you see. They beat estimates, and the stock might go up a little bit. At the end of the day, the numbers are the numbers. No matter what the analysts say, the numbers are the numbers of what you're reporting. And you're seeing earnings slow because you're supposed to earn $1.25, supposed to be a lot, but it's $1.05, right? That number, whatever the analysts believe is what they believe. That's what we trade on. I get it. I understand. That's what I do for a living. I track this stuff. For me, my job is to show discrepancies with sell-side analysts. Because if you could say if a company's going to report $1 and I see that they're going to report $1.50, the consensus, people think it's going to be $1. So I would recommend that stock saying these guys are way too conservative. Or vice versa. Maybe I say, short this stock because these earnings estimates are way too high. But at the end of the day, the number is the number. The earnings number is the earnings number. And you're seeing earnings slow, which is not a great sign, especially if your stock's trading at a high multiple. So even though we saw 75% of companies in the S&P 500 beat earnings to the upside, which is a great headline, and people are mentioning and talking about, yeah, you're celebrating it, it's not necessarily great news considering most of that came from energy stocks. And you don't have a huge following of energy stocks in the S&P 500. It's not this major component like technology is. It's not. But if you remove that, S&P earnings are down 4% year over year. Right? So let's use the formulas. It's so funny because you don't hear X energy when it comes to earnings, but you hear X energy when it comes to the CPI. Why don't we be more consistent? Let's be more consistent. Let's be real with people so we know exactly what's going on. That's why I listen to my podcast. But you wouldn't know that earnings for the S&P 500 Q2 year over year fell 4% by watching your favorite media channels. No way. All you hear is that 75% of companies beat. Things look rosy. Not a recession. Earnings are strong. No, they're not strong. They're down 4% year over year. They're not strong. Now look at valuation for the entire S&P 500. We're trading at 17.5 times earnings. We're down to like 14. That's forward earnings. We're down to 14, which is insane considering on average, the 10-year average is about where it is right now, 17.5. So now we move back to the average. Sharply. And you're noticing in portfolio, your stocks are up tremendously since July 1st. But should we be at that average market multiple of 17.5 times right now with earnings down 4%? Again, taking one of the smallest components, the S&P 500, out of it, like we would do with the CPI. It makes you think we could be due for a pullback. And again, we trade the same valuation when earnings were growing 10% plus annually for years. Interest rates were zero. The Fed was aggressively buying bonds, and our government injected $11 trillion, which is insane. $11 trillion stimulus into the economy and kept going in 2021, even though oil prices hit all-time highs. And it's even funnier that they're still doing more and more spending. More spending. What is this thing called? The Inflation Reduction? I think we're going to spend more money, and it's the inflation reduction. It's getting to the point where the politicians are like, hey, all the people we're talking to are a bunch of idiots, okay? They don't know they're idiots, but they're idiots. So let's just call it something, and we'll spend more money, as much money as we can, right? And do we really need to spend more money? Do we really need to hire more IRS people? Do we really need this right now? Really? Do we need to push this through? And congratulations to Manchin. What did he get? Holy cow, remember, he was the holdout on the Democrats. That guy probably has like 9 houses overseas someplace just to get that guy to reverse. Good job. That's what you need to do as a politician. Say no, 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 no. And then they're going to get, listen, we'll give you anything you want. You just need to say yes. Okay, yes. Right? It's great politics. It's awesome. But $11 trillion in stimulus. Now we're removing a lot of that. Should we be trading at the same multiple as a 10-year average right now? I would think it should be a little bit below that. Probably why short interest, if you notice, is starting to ramp up to the highest levels in months. Really ramping up here. That's why you saw Bed Bath & Beyond yesterday AMC, GameStop, right? You're looking at the short interest. Look for Bed Bath & Beyond. Short interest was 15% in May. It went up to 35%. It was 35% 2 days ago. And what happened? The ape said, it's time for the short squeeze. Talk about Bed Bath & Beyond surged 30% plus. A lot of that is short covering. So when you see this massive shorts piling in, again, in order to get out of that position, you have to buy. So if that moves the wrong way, you're forced to buy the stock at whatever price. The stock's at 20 and you're short and it goes to 25. You're like, I'm out of here. In order to be out of here, you got to continue to buy, which means it's going to go to 27, 28. And then the rest of the shorts are going to be like, holy shit, I'm getting buried. I got to continue to buy. And that's where the short squeeze is. It goes higher and higher. Look at Bed Bath Beyond, AMC, GameStop yesterday. You only see those types of moves when you have big short positions because you're forced to buy. Just like we saw in Bitcoin, just like we saw throughout the crypto industry, in small caps, especially in biotech, was the opposite. When you're forced to deleverage, you're selling stocks no matter what price they are because you need that money. You're not looking at valuation and saying, oh, this stock went from 80 to 10 and I'm going to wait for it to come back. No, you need to sell it and get out of it. And it brings it down to 8 to 6 to 4. And that's great for individual investors. That was a great time to buy 8 weeks ago, 9 weeks ago. But we've come up tremendously since then. And then when we look at individual names, even more individual names, it gets even more confusing. And Novavax cut their guidance just a little bit. They only cut their guidance a little bit. They cut it from $5 billion to $2 billion. What? I mean, it kind of makes sense because we know vaccines are shit, right? We know that. And even the current party is saying that as well and saying, well, you know, these things really didn't work as well as we thought, whatever. Now, right? Again, if you didn't get vaccinated, you're the enemy of the state. Holy shit, I can't wait to see books and stories of what we're writing about this 5 years, 10 years from now. What a joke. That stock fell 25%. It's trading at 42. Just to put that in perspective, Novavax was at $270 9 months ago. Holy cow. Imagine owning that stock all the way down, and you're saying, okay, well, it's down to 50, 55, and down from 270. You're like, okay, you know, the market's coming back a little, and then bang, they lower guidance like that, and you get hit for another 30% decline, 25% decline. But again, obviously, people are getting fewer vaccines these days. That's why companies like the Novavax, Moderna, Pfizer are trying to shove their vaccines down the throat of kids between 6 months and 5 years old, even though they need 3 doses to get efficacy up to 80%. Three doses. And if you're looking at adults, when these vaccines came out, which I covered, and it was amazing because I had great research on this and saying that before they came out, there was an analyst, I think it was from Jefferies, that was amazing. And I said, look, I don't know if this is true or not, but this guy has a lot of credibility. He said that efficacy rates are going to be above 90% for these vaccines when they release. And even people are like, you're crazy. And it did. It came in above 90%. That guy gets all the credit, not me. I just have access to a lot of this research. But the efficacy rates for adults, these vaccines, are 93%, 94%. I mean, are you kidding me? For kids? So it's telling you that the Pfizer's, Moderna's, they don't give a shit about your kids, right? Since more kids die from the flu than COVID at this age, all the way up to 12, right? We know that. Those are the facts on the CDC website. In case you want to look, they're on the CDC website, so don't fight me on that. Just look on the website. That's what it says. Plus, numerous, if not all, studies show that kids getting COVID early builds up their immune system incredibly, which by far is the best defense against COVID than any vaccine, right? We all know that. But yet we want to shove this down your throat, not because it's good for your kids, because our profits are getting destroyed, especially Pfizer. Pfizer's like the shittiest company, bribing the FDA, all this crap. You got to go back at Pfizer's history, how terrible it was. You know, Merck eating their lunch, all the other companies just eat their lunch, killing them. And then everything worked out with the vaccine. Dr. Gottlieb on the board of Pfizer, giving advice on TV as a person that everyone's listening to. That's not the ultimate conflict of interest. I don't know what is. It was pretty amazing when you look at it. Getting back to the individual names, sorry about that mini rant there. I had to go there. Imagine owning Netflix or Meta, Match Group. These are names that have gotten annihilated. They're up a little bit off their highs. NVIDIA, right? Another bad quarter. People are like, things are going to be great. Gaming across the board has come down. Look at Intel's numbers. Look at Snap, Mohawk Industries, Dish Network, and you own any of those going, holy shit, we're in a recession. This is the worst economy ever. based on their latest earnings results. But then you have defense companies, Lockheed, you have Hershey's, Kellogg's, done well this year. If you take the past 6 weeks, again, we have many beaten up names, especially in biotech, down sharply the past month. But look at Cathie Wood's portfolio. Got annihilated this year until July 1st. Coinbase up over 100%, especially after the deal with BlackRock to provide trading custody service for the investment fund manager, which only has about 10 trillion assets in management. That's a huge endorsement for Coinbase, by the way. And I'm not a fan of Coinbase because I think a lot of everything that they trade on there, other than maybe, I'll give them 5 of those cryptos, are going to be deemed securities. Sooner or later, they're securities. And when they do, those guys are going to run because they're not going to show their financials. They're not going to file. They're going to run. And they're all going to get fined and pay fines. That's where you'll see security tokens, a lot of stuff come back to this market with Coinbase. So I'm not the biggest fan of Coinbase, but the fact that they're able to trade cryptos and you're looking at the biggest asset manager in the world, choosing them or choosing their platform, it's a major endorsement, right? Especially with Celsius, Voyager, and other platforms went under who were lending at 15%, 20% rates for staking your coins and stuff like that. It's a good endorsement. But getting back to Cathie Wood, Coinbase, she was buying up over 100% since July. Roblox, a name that I really like. I can't believe it's down as the rest of the names. Some of these names, you're seeing revenue grow, massive freaking losses. I mean, you're looking at Roblox. Roblox is a real company. I mean, tons of people on that platform. You're seeing everybody rushing there through the Metaverse, launching Metaverses through there and trying to build their Metaverse with Nike and how many companies. That's a great platform. Up 50% since July 1st. I just didn't think it should be down as every other technology company because they're seeing pretty strong growth. The numbers are okay quarter over quarter because they were growing so freaking fast, but that's a real good name. Block is another one on her portfolio, up 40% since July 1st. Unity's up 35%. I think they just accepted a bid or a takeout offer. You got, and that's one of the key companies in the Metaverse, with Unreal and Unity being the two gaming engines that are powering the Metaverse right now. Huge growth, and the amount of money being spent, hundreds of billions of dollars now getting thrown into the Metaverse. These are the platforms they're using. Unity and Unreal, everyone. That's where the money's going. That's up 35%. Robinhood's up 30% since July 1st. So you take everything as a whole, right? How confusing was everything I just said? And some stocks are down 40, 50%. Others are up 100% over the past 8 weeks, 6 weeks. Confusion over the data, every piece of data. I mean, you're seeing productivity go down to levels not seen in the history of our market, yet we're seeing inflation continue to go higher where output costs, right? That was just released, going higher due to inflation. Gave us a number that we've never seen before in the history of that data with productivity. Again, the CPI is high, unemployment, again, that rate's pretty good, but yet housing's dropping off a cliff all over the place, and it's nuts. We have clear positives and clear negatives where bulls and bears, both sides of the aisle, have lots of data points to support their thesis. And you're looking at it going, holy shit, this is confusing. I don't know what the hell's going on here, but this is more confusing than it's ever been. I get it. But there is good news here. Over my 30-year career, the best market environments usually happen when you have a healthy mix of both bullish and bearish indicators and investors. The problems happen when everyone leans to one side or leans to the other side. That's when you see the problems happen. Because it always overshoots. It's better to be in the middle. When you're in the middle, it usually chugs along and it's pretty good. And you got a little volatility here and there. We'll go and see volatility since the Fed's raising rates, can continue to raise rates through September. Let's see what happens based on the data today. They better stop after a 50 basis point hike in September. If that changes over the next month, that's different. We see a massive CPI number, we see unemployment, that's different. Maybe you go 75 basis points and say we might continue. But if we continue to see these prices and housing, I mean, everything tail off the way it is, and even worse, we're seeing that right now. We're seeing prices come down in a lot of places. Retailers sitting on more inventory than they've sat on in probably a decade, which they're going to have to sell at cheaper prices. That's inflation. Data that I track for supply chains, they're saying that demand is slowing. You have crates sitting on their lots now for 8-9 days. But they're starting to charge these companies. You didn't see that for a very, very, very long time since they started injecting money into the system. That's easing supply chain concerns because you're seeing demand fall. That's what they're reporting. This is the data has been tracked 25 years. We have access to. Again, it's not biased or anything. These are just the facts. But having this split environment, guys, is a very, very good thing. Even though it's confusing and you're like, I don't know if we're inflated, I don't know if we're not. It's very difficult to forecast your business or how much you want to spend. There's companies removing their estimates right now going, I'm not too sure what to do. Let's just wait. I don't know what the Fed's going to do. If they're going to raise rates, it's going to result in more and more people. Their bills are going to go higher and higher. Expenses are going to go higher. They're going to be able to borrow less. That could result in less demand, fewer customers. So let's just, be careful with our guidance. I get it. But during those times, especially as we see with the Fed being on the right side of the trade now, remember, uncertainty is the death of equities and stock. When you have uncertainty, you don't know what's going on. That's why it went down 11 out of 12 weeks. The uncertainty of the Fed completely doing about face going, they didn't know what was going on. Holy shit. We're totally wrong. They're not wrong now. They're not wrong now. Today. Again, we're talking about today. Forget about it. You want to talk about the Fed, how terrible they've been? Fine. It's useless, basically. It's not going to make you money telling you how terrible the Fed is. What's going to make you money is seeing what the Fed's going to do going forward. Going forward, they're going to raise rates. I just think it's going to be a lot less. But if they go even higher and they go to 3.5 or higher, look out. I think 3% is perfect. Let's see in September. But at least the Fed's on the right side. That's important. Where we all see inflation now, not the whole entire world, and the Fed didn't see inflation like it was, right? The Fed was the only person that didn't see inflation. I guess they don't pay their bills. I have no idea. They didn't see inflation coming. Now they do, and we all do. Then we have Bullard and a lot of these other Fed presidents going crazy, 4%. That's what you want to see. You want to see them nervous, holy cow, nervous on that side, not the other side. There's no inflation. We're going to be fine, right? That suggests bullish market conditions. And then when you do an about face, what happens if the market crashes? Totally gets destroyed. We've never seen that. 11 out of 12 weeks we were down. Never saw that in the history of the markets. That's how terrible it was. Now they're on the other side. Inflation. Holy cow, we got to worry about that. That's where you want them to be. This way they see it and they're concerned and they can do things about it. And they can also ease back where the Fed had no choice but to say, we need to shrink our balance sheet right now and raise rates incredibly fast, at the fastest rate that we've seen in over 30 years, close to 40 years. We're not there anymore. So when you see this back and forth, the confusion, it's almost like when we have a split government. When the Democrats, Republicans hold power in all three branches, those are usually the best market conditions because you don't have, idiots on either side passing radical agendas, which we're seeing right now. And we saw that with Republicans. So they're pushing everything through before November because it's not going to be that way anymore. It's going to be split. We all know that. But the confusion is I know it's difficult to navigate, especially some of your stocks might have gotten nailed for 30%. Some of your stocks might have gone up 20, 30% in the past couple of months, and you're all over the place. But that confusion and the back and forth and the split between bulls and bears, while confusing, is usually a healthy sign of the markets. I know you got CNBC on, or Fox Business on, or whatever you're watching, and you watched 20 guests yesterday. 10 said they're bullish and 10 said they're bearish. You're like, I don't know. You know what? Just own good quality names. We're going to see a nice, little bit push higher, not as high as we went, right? We're incredibly bullish. Remember, you got to look at the conditions. You can't say, Frank, you were really bullish like 8 weeks ago, and the market fell the first 2 weeks pretty sharply before rising. But we did have what? Insider buying near record highs back then. Sentiment indicators at all-time lows back then. I mean, it made sense for you to we clearly overshot. But right now, we're kind of in this market that the cream's going to rise to the top. Not everything is going to go higher, which we're seeing in the market. You're seeing it across the board. Some companies are getting nailed, and some companies are doing very, very well. So you listen to guys like me to separate the BS from the real companies. I'm not saying I get everything right, but there's going to be clear winners here. And you're probably going to see the market chug along pretty good, a little volatile through September until the next Fed meeting. So I'm not saying aggressively buy every single stock right now. Right now. I said 8 weeks ago. But right now, and you're looking at today and going forward, we're going to see separation of companies within industries that do well. We saw it during earnings season. There's companies that have pricing power that said, we're not seeing recession, we're seeing demand through the roof. And there's other companies saying, wow, supply chain concerns are still hurting us. It's getting global like Micron. But not all chip companies are seeing that. You're not seeing every single company in the industry go down, every single in the industry go up. We're seeing split, and that's what you want to see, because that makes it a stock picker's market. We pick the good names. And how do you find the good names? Focus on the ones with solid management teams. Those have been honest on the last couple of conference calls and not bullshitting you. which we've seen a ton of, especially when it came to supply chain concerns. Those that have pricing power, which isn't too hard to see, look at their margins. Those where insiders are buying today, which you're not going to see as many. You see more sells than buys now because stocks have risen so much off their lows. But still, you have insiders buying. Focus on those names. If the insiders, especially if the stock is up well off its lows and insiders are buying. I'm not talking about 10% owners of funds. I'm talking about the CEOs, the CFOs, the COOs. If they're buying, that's a good sign. They know their company. I'm not talking about them buying 50,000 because they just got the job and they want to show support. Which you see if they hire a new CFO, he buys 100,000 shares. No, not one of those. Guys that have been there for 10, 15 years, whatever, 5 years or longer that are buying, that's a good sign. They know the business and they see things in the future, contracts in the future, demand with their business. That's a very, very good sign. Look for that. It's not difficult to see that. You can find on many free sites. FinViz is one of them. Look at companies that are buying back their stock. This way you have that floor. If it does fall, these guys are there to buy back a lot of their stock, which means they have a decent balance sheet. And even companies that are raising their dividend. Clear sign. You don't raise your dividend unless you believe your business is going to be good for the next 6 to 9 months. You're not going to raise your dividend. Unless you're one of those dividend aristocrats that have it's 50-year track record that they have to raise and they'll raise by a penny or whatever. I'm not talking about that. But guys that raise their dividend like 10%, 15%, 20%, companies are not going to raise their dividends unless they see a healthy outlook over the next 6 to 9 months. Especially since a lot of them during COVID suspended that dividend. So they're not under pressure to get that dividend back up and say, here's our dividend, we got to get. They're not under pressure. So for those companies raising that dividend, that's a very, very good sign. There's plenty of names that fit this profile. Of course, if you're looking at small caps, take out the dividend thing because you don't want small caps paying dividends all the time. I'd rather see growth out of small caps. Someone's covered all my life. That's what I talked about with Charles Payne on his show yesterday about small caps and breaking through and how they're still relatively cheap, still incredibly cheap compared to large caps. A lot of great names in there. But we're finding plenty of companies that fit the profile. We're recommending them in our newsletters, Curzio Research Advisory, Curzio Venture Opportunities right now. But if possible, which I know it's impossible these days, especially when you have a phone in your hand, you have to look at something all the time. I can't tell you how often where I'm at a restaurant or I'm just when I was in Dominican or a line someplace or, whatever, just people are on their phones. They need to be fed information constantly. And what I've realized in life, the more information you have, the worse it is. And that's coming from a research analyst, which has to look at as much information as possible. But that's my job. But when you're looking at so much garbage all the time that's being fed, and it's being fed based on how they can control your brain the most, how you can click this headline the most, how we can make this as crazy as possible the most. That's what you're going to believe. That's why you're seeing kids. I saw kids with families, they're wearing masks in Dominican outside. They were kids. And maybe a tiny bit of them had underlying conditions. I'm not talking about 65-year-olds who have underlying conditions or they're on flights. I'm talking about young kids. Young kids, wearing masks still outside. I'm like, holy cow. Again, it all depends on who you're listening to. So even, you listen to this podcast, but do your own research. Do your own research. You can challenge me, challenge anything, but this is you. This is your life. Be careful what you listen to. Be careful who you're listening to. But you should always be doing your own homework, especially if you're doing your homework and you're saying things like what I was saying in COVID very early on because I was blessed with having great information and interviewing people. A lockdown in January and February in Europe and in China and understanding how it was coming here. And so many doctors have reached out to me and saying, don't mention me. I was just very fortunate. As I started reporting this stuff, people started attacking me, going crazy. You got to see my ratings. Look at my ratings on it from, iTunes of, girls get political and all this bullshit, everything. I mean, you just rip me apart. I have kids. I try to report to you because I have kids. Forget about the money for a second. I think it supersedes everything, doesn't it? But when I was getting attacked by people, for me, I knew I was right. Because when you have a thesis on something, everyone's like, yeah. Like even now with the metaverse, and people, I have a couple of clients saying, Frank, you're in the metaverse. I don't know if I want to be with you. Not too much in stock. I'm into stock. We have 3 newsletters on stocks. We have Curzio wants folks on private deals as well. You have access to everything. Of course, that's our core business. But you're challenging me on something that this is as close to a guarantee as I've seen And one of the only opportunities I've seen in my career where you could actually buy the next Microsofts, Apples, I wouldn't say Google since they came out at such a high valuation, but the Amazons that could absolutely make you and your family life-changing gains. This is where the world is going. This is why Meta, $1 trillion company, changes business model. This is why $120 billion is flowing. This is why every major technology company is pushing into the metaverse right now. This is the future. There's plenty of evidence. This isn't guessing. You follow the money. You see how much money is pouring into this industry. The contacts that we have, this is something you have to have exposure to because you're going to be able to make an absolute fortune off of this because it's that early on. But the fact that so many people doubt me makes me even more convinced and have more conviction. So my point is, when you have a thesis on something and you're doing your own research and you're telling your friends and they're like, oh, and they're like yelling at you and think you're crazy, chances are you're right. When everyone's on the right side, everyone's agreeing with you, that's when you have to worry. That's when you have to worry. But do your own homework, do your own research, because when you're watching TV and the stuff that I'm watching right now, holy cow, man, is it confusing as hell. What you do know is it's a good split between bulls and bears. It's not a bad thing. It's usually good. It's healthy for market conditions. Probably going to see the market chug a little bit higher. Yes, we're off our lows and maybe we'll pull back a little bit, but there are clear winners and clear losers. It's not that the whole market's coming down like it did a couple months ago and through November, or the whole market's going up like it did for a certain period before COVID. This is different. It's a stock picker's market. There's companies that are getting done and others that aren't. And I'll be able to find, I'm going to try my best to find as many of those ones that are doing good and throw those in the newsletters. This way we can all make money off of them. And also, while focusing on the metaverse and crypto, which BlackRock, 10 trillion assets getting into, Fidelity, 4 trillion assets getting into, they're pouring their money into it because their clients want to be in an alternative asset class. You should all have access to alternative asset classes. I'm not saying go all in. I'm not saying even go in 25%, but you should have 5% of your allocation into things like this. And I got to tell you, one of the things that pisses me off the most is when people say, you know, the Peter Lynch theory, you have to invest in things you understand. You have to invest in things you understand. People say it all the time. If that's the case, you would have never invested in cloud in 2012. You would have never invested in half of the technology trends where stocks are up thousands of percent because a lot of this shit you didn't understand and I didn't even understand. It took me a long time to understand. But you have to start learning about this. You have to start listening to people who are in these areas that say, hey, this is the area that's going. And investing in Microsoft was a dying company until Nadella got there and said, look, we got to focus on cloud, and turned it into $2.5 trillion valuation. Even higher than that. Bill Gates is a brilliant guy, but he missed mobile by a mile, which hurt that company tremendously. Let Apple and a lot of other companies surpass it. And then they were even a little bit late to the party when it came to cloud behind Amazon. They corrected that, and look at that. But how many people knew what cloud computing was back then, or data analytics? Or what about in 1995, 96, when the Today Show was like, what's this .com? What's the at symbol? What the hell is this? I don't know what's going on. Imagine, right? Imagine investing in technology companies back then and you still held them to today? Holy cow. You probably have 3 helicopters, 4 islands, and 19 houses. But you really didn't understand it. You just knew, wow, this trend is pretty good. And this guy's telling me that this is a great trend. Put a little bit of money into it. A few $1,000s. That's what people are seeing when it comes to crypto and the metaverse and NFTs. That's what people are seeing. They're pulling a little bit of their money into it and say, hey, I want to be in this. This is an alternative asset class just in case, because a lot of these other stocks, I can't get in early anymore because they come out at multi-billion-dollar valuations at 50 times sales by the time the average investor could buy them. That's why they're all down 60, 70, 80%. SPACs are down, IPOs are down on average still of 65, 70%, even though they moved off their highs because the valuations are insane. When it comes to this other areas of the market, whether it's the metaverse or crypto, you can get in early. But getting back to the major theme of this podcast, guys, be careful what you're watching on TV. It's more confusing as hell. That confusion could turn out to be pretty good because when you have bulls and bears fighting each other, that's what you want. You don't want 100% bulls, 100% bears. That's when you run into trouble, when that pendulum swings all the way to one side. And we've seen that. We've seen that's why the market crashed, and we've seen it when 8 weeks ago, when everyone's more bearish than they've ever been in the history of these markets, based on sentiment indicators, which is crazy. So let's end it there, guys. Questions or comments? I'll sure have a lot. FrankCurzioResearch.com. That's Frank at CurzioResearch.com. Really appreciate all the support, and I'll see you guys tomorrow. Take care.